Hello, everyone. Thank you for joining us for today's webinar, The Effects of the Tax Cut and Jobs Act. I'm going to start the presentation today with a few housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. While we might not have time to get to them at the end of the presentation, we'll definitely reach out to you following. Next slide. Now modify your audio settings to make sure you can hear what we're talking about today. If you're going to use a telephone, please click the phone call audio option. If you're listening through your computer, then please click on the computer audio option. Now a quick intro of our speakers today. First up is Dean Quiambo, partner with Armanino. Prior to joining the firm or transitioning to our chief relationship builder, he worked with our audit department for more than 12 years. He helps numerous companies address their tax, audit, and outsourced accounting needs, and he's also a CPA. Then we've got Jerry Clancy, who's an excellent tax partner here, formerly with Deloitte and PwC. He works with clients in manufacturing, distribution, technology, the gamut, and specializes in taxation and business advisory services for individuals, families, and businesses. And a quick overview of our presentation, and then I'll turn it over to Dean and Jerry. We're going to look at some key dates of the new act, effects of the act on individuals and families, businesses, and international issues in particular, and then a quick Q&A as time allows. And with that, I'll turn it over to Jerry and Dean.
Hello, everybody. Nice to be talking to you today. It's kind of a seminal day here in the tax world, and what I thought we would do is just kind of sort of walk our way through these different provisions in the new Tax Act as it's proposed right now. As far as dates are concerned, we're actually all ready to this December 20th date where the House has revoted and approved the act, and now it's essentially just ready for the president's signature. We're not sure if that's going to happen this year or next year. Just really depends on whether or not, when he wants to make the big splash, if you will. Although whether he signs it this year or next year, the effective dates are for the tax year beginning January 1, 2018. So with that, let's just jump right into what the impact of this act is for individuals. So what's happening is the individual tax rates, there are still 7 brackets, but effectively the rates on the rate thresholds have dropped. So for example, the top rate of 39.6% that exists today is dropping to 37%.
Great. Now, Jerry, when I see something like that, the first thing that comes to mind is, what about the marriage penalty? Is that still around?
Yeah, so what's interesting is we thought that perhaps the marriage penalty, which is effectively a penalty that applies based upon how the rate brackets are designed. So for example, if you were to file singly versus married filing joint, how would the tax be calculated based upon the way that the rate brackets work? And as it turns out, the marriage penalty is still alive and well, because while the top rate, for example, taxes at 37% for taxable income over $500,000 for a single individual, for a married couple, that threshold is only $600,000. So you can see that the marriage penalty is still there. Got it.
Okay.
The new Tax Act significantly increases the standard deduction. It basically doubles it, and for married individuals from $12,000 to $24,000. We also have the ability to continue to write off state and local taxes, state income taxes, real estate taxes, property taxes, things of that nature. One thing to keep in mind is that real estate taxes relating to businesses are still fully deductible, and there's no limitation for those, like real estate, rental properties, that sort of thing.
Jerry, I've been hearing a lot about what this act will do to those in the high tax state taxes, like California and New York. What is it looking at our impact?
So it's a very negative impact for high tax states. So if you were to take a person living in California, for example, and just speaking hypothetically, let's say a person in California made $1 million, and let's just assume that the California tax rate was 10%, they'd pay $100,000 of California taxes on that. And that 100,000 used to be deductible against their federal taxes. Well, now only, up to $10,000 of that would be. So if the individual is also, deducting property taxes, then effectively it's likely that the property taxes would exceed $10,000. So now that entire $100,000 state tax liability is no longer deductible, and the effect at, let's just call it, 40% roughly, is a $40,000 additional tax liability that a California taxpayer would have. So it's pretty negative in that regard.
Ouch. Okay.
The new Tax Act expands the child tax credit from $1,000 to $2,000 and preserves the child and dependent tax care credit. It also preserves the adoption tax credit. So let's talk about the mortgage interest deduction. The House version and the Senate version had different thresholds for what constitutes the mortgage interest indebtedness for which you could deduct mortgage interest. What they settled on was that for new mortgages beginning after December 15th, the threshold would be $750,000. They would, though, respect the old mortgage limit of $1 million for prior mortgages, so if you have a mortgage and it's $1 million, the mortgage interest on that's going to continue to be deductible.
All right. Well, the big question there is, what about home equity debt, Jerry?
Unfortunately, home equity debt, even existing home equity debt, is going to be no longer deductible in 2018.
Okay. Ouch.
So the Tax Act continues to provide relief for medical bills by expanding the medical expense deduction for 2018 and 19 for medical expenses exceeding 7.5% of AGI. So that percentage dropped from what it was previously at 10%. It also expands the charitable deduction contributions. So the 50% contribution threshold is still there, but it actually has increased to 60% beginning in 2018. The other thing to note is that just talking about itemized deductions in general, miscellaneous itemized deductions are essentially being eliminated. So, those are the type that, employee business expenses, those types of deductions will be eliminated in this act. The other item is that the individual mandate, the penalty for not participating in Obamacare is eliminated. The new Tax Act maintains the earned income tax credit and improves the savings for education by allowing families to actually use their 529 plans to save for elementary, secondary, and higher education. It was previously just higher education. So, if you start putting money away for your kids and you want to send them to a private school, you're going to be able to use that 529 plan for that purpose.
Okay.
It continues to provide support for graduate students by continuing to exempt the value of reduced tuition from taxes. And it still maintains the 401k plans and the IRAs. And actually, with respect to alternative minimum tax, there was a lot of talk about whether it was going to be eliminated. It wasn't eliminated, but the thresholds are increased so that fewer people would be subject to it. And, so for example, in California, where you no longer can deduct state taxes, which is one of those AMT add backs, it really makes the probability of being an AMT quite a bit lower. The new Tax Act on the individual side also provides relief from the estate tax. So it used to be that the estate tax exemption amounts were roughly $5.5 million for each individual. So a husband and wife could shield from estate taxes roughly $11 million. All those amounts are doubled. So a couple can now shield over $22 million from the estate tax. So before we get to the business side, I did want to mention a couple of areas. One is that the cost basis of securities. There was talk that essentially that the new tax act would not allow for the use of like specific identification or different methods other than FIFO, first in, first out, for the sale of securities. So you'd have to basically use the first in, first out. So the oldest securities that were acquired would be the first ones that were sold for purposes of calculating your cost basis on the sale of securities. That ended up not being changed, so that was good news. And along those lines, in talking about sales and capital gains rates have not changed. And the only change in this area is the area that deals with the carried interest.
So carried interest, I've been hearing a lot about that on the news, Jerry. Can you explain to us what that is and who that is going to affect most?
So carried interest has been around for a long time. It has to do primarily with investment managers, venture capitalists, where essentially when they would form a fund to basically invest in portfolio companies, they would basically have an arrangement. A typical arrangement would be a 2 and 20, 2% management fee and what's called a 20% carry. And that carry was basically a performance fee for the investment that they had in the portfolio companies. Now their investment was very low, so relative to the amount of return that they would get. But the arrangement was essentially once a hurdle was reached and the portfolio company was sold, the investment management firm would earn 20% of those proceeds on the sale of one of those portfolio companies. Some have argued that given that capital gains rates and the low aspect of the capital gains rates has to do with risk of capital, and that therefore, since venture capitalists don't really put much capital in on these kind of arrangements, that most of the funds, nearly all of the funds, come from investors, that why should they receive capital gain treatment given that they don't have much at risk? The provision has survived, although the holding period for capital gain treatment is 3 years.
Got it. Okay.
So that's the story on carried interest. So now turning to the business side. So corporate tax rates have been reduced substantially, down from 35% to 21%. And I guess the reason for that is that the United States does have one of the highest corporate tax rates in this country, and many have believed that has actually made us less competitive in the world marketplace. It was interesting because yesterday I was talking to one of my other tax partners who had a theory that, well, the reason why we're able to charge such a high rate is because we're sort of the premier country in the world. So there's differing arguments about whether that was a good thing or a bad thing and whether that should have happened. But in any event, it has happened, and it's going to result in corporations having a lot more cash flow because of the reduced corporate taxes. Pass-through entities are very interesting as far as what's happening with this new tax act. Essentially, for all businesses that are pass-through entities, the first $315,000 of joint income earned by all businesses organized as S corps, partnerships, and LLCs will receive up to a 20% tax deduction. And the effect of that is for businesses, this 20% deduction really amounts to about a reduced marginal tax rate of 29.6% rather than the 37%. And the goal there was to try to some extent, equate the tax rates for business income flowing through pass-through entities with the corporate tax rate.
Now, Jerry, is there any limitations, on that deduction?
There are. So, for example, in order to get to the 20% rate, you have to basically apply a couple of limitations. Owners are allowed to calculate their maximum deduction based on either 50% of their share of the W-2 wages paid, or if in the case of maybe a rental property, a real estate operator or somebody like that, 25% of their share of W-2 wages plus 2.5% of the cost basis of qualified property. So you can see where highly capital intensive businesses that may have low wages would use this second threshold. Now, there is one unfortunate part of this for folks like accountants, lawyers, and doctors, and that is that above this $315,000 threshold, service type businesses like that do not get the 20% deduction. And in fact, this 20% deduction essentially gets phased out over the next $100,000 of joint income that those folks receive in excess of the $315,000. So, essentially, if those folks are high earners, they're not going to receive any benefit relating to this 20% deduction. So let's talk about then the world of depreciation and immediate expensing of equipment. It's another fascinating area in this tax code because it's very favorable to taxpayers now. First of all, let's talk about bonus depreciation. So bonus depreciation is basically a type of write-off where you can immediately expense the cost of equipment. For property placed in service after September 27th, you are now eligible for bonus depreciation on both new and used property. It used to be only for new property. You'll also get this 100% bonus depreciation on that type of property through the year 2022, and then it'll be phased out over the next 5 years. So for the foreseeable future, we're going to have that. And for 2017, after that effective date, you can elect to use either 50% or 100% bonus depreciation. With respect to Section 179, so Section 179 is another expensing option for equipment. There are new limits. Up to $1 million can be expensed with a phase-out threshold beginning at $2.5 million. It is also now available for residential and lodging property owners. It used to not be eligible for that. And also it's eligible for commercial property owners with respect to improvements for roofs, HVAC, fire, and security systems.
So Jerry, I'm hearing that this is going to have a significant impact on all of our real estate operators.
It's going to have a definite impact. I'll go further into how it affects, for example, depreciable lives for qualified leasehold, restaurant, retail improvements no longer exist because they've been replaced by qualified improvement property, which now has a 15-year life and is eligible for bonus depreciations. This is just a very big windfall for businesses that are capital intensive and real estate intensive. One thing to keep in mind is that there is a potential interest expense limitation of 30% of adjusted taxable income for businesses that are over 25 million in gross receipts. Okay, so now turning to the area of credits. The new tax act has retained the low income housing tax credit and has also preserved the R&D credit, which is so popular to our high-tech clients and is so important for those purposes. They've also retained the tax preferred status of private activity bonds, which is a rather minor point. The new tax act eliminates corporate AMT, thereby lowering taxes and eliminating confusion about having to calculate these things. The new tax act also has modified, which is not in this, but I'll just throw a few other things out, has modified the net operating loss rules. Under current law, NOLs generally have a carryback period of 2 years and a carry forward period of 20 years. Now, under this act, the NOL carryback period would generally be eliminated and the carry forward period would become indefinite. the amount of the NOL deduction allowed would be limited to 80% of taxable income computed without regard to the NOL deduction. So getting back to this limitation on business interest, essentially the new provision would generally limit the interest deduction on business interest to business interest income plus 30% of the taxpayer's adjusted taxable income. For partnerships, that limitation would be applied at the partnership level. The conference agreement generally applies to all taxpayers and provides an exception for small businesses with average annual gross receipts that do not exceed 25 million. The last area that I would like to cover would be, and then I'll take questions from Dean here, is the area of like-kind exchanges. So like-kind exchanges were really up for review in this Tax Act, and there are various proposals, including possible elimination of like-kind exchanges, which allow a taxpayer to exchange one piece of property or one piece of equipment for another and not pay tax on that transaction under certain circumstances. The new Tax Act limits the scope of like-kind exchange non-recognition to real property, not held primarily for sale, i.e. for investment purposes. If you're a dealer in property, you won't get to be able to use this. Now this new provision eliminates the ability to do that with respect to personal property. So that's the limitation on that. One other point is that the Section 199 deduction, the qualified production deduction, is now repealed, effective after 2017. Now, when we talk about research and development and the ability to continue to use that credit, one thing to keep in mind is that beginning in 2022, the R&D basically expenditures will be required to be capitalized and amortized ratably over a 5-year period. And any expenditures attributable to research that's outside the United States would have to be capitalized and amortized over 15 years. So that kind of covers the general business areas. And I think what we do now is, unless you have any questions, then we'll move to the international provisions.
Yeah, let's take a look at the international. We do have questions, but let's get through the international quickly, and then maybe we'll see what we have there.
Okay.
We'll see what we have time for.
Great. So what we've had in the United States for years is basically a worldwide tax system where U.S.-based businesses, if they conduct business in a foreign country, essentially they are taxed at U.S. tax rates when those foreign subsidiaries repatriate the funds back into the United States. That essentially puts us at a disadvantage with foreign enterprises that are conducting business in those foreign countries, because the tax rates in those foreign countries are generally lower than U.S. tax rates. So what this new Tax Act does is it moves away from a worldwide system to essentially a territorial system where the foreign subsidiaries are going to be taxed at basically those lower rates of those foreign countries. Now, as a result of this move, there is a transition tax, basically a one-time deemed repatriation tax, payable over 8 years on the unremitted earnings and profits of those foreign subsidiaries. And it's basically at a 15.5% rate.
So it's like a catch-up, it feels like.
It is. It's kind of like, well, there's all this sort of deferred earnings that are out there, and essentially, this is the way to kind of get that sort of caught up. Okay. So it's kind of it should be a big revenue boost for the Treasury because there are literally trillions of dollars out there. Okay. And theoretically, it should make our businesses more competitive in the world marketplace. That's the idea behind it.
That was the goal. Sure. Okay.
So you can see that there just are tremendous changes to our tax system, and we're just beginning to to understand the details of these. Of course, until the president signs it, it's not law, but it looks highly, highly probable that this is going to happen. And we are basically poring over all of these provisions to determine what the best course of action is for our clients.
Yeah, Jerry, and it seems like now is the time more than ever to be proactive and to have the regular strategic tax meetings with your provider. I would say one more thing is that we do know that we have there could be a lot of nonprofits on the line. We will do a separate webinar for the nonprofits and how this will potentially impact them. We have seen a good amount of questions come through. There's a lot of questions and we won't be able to answer them all. So I think what we'll do is we will follow up individually and answer those questions to you directly and take it from there.
Thank you, everybody.